Can you hear me okay? We are live. Welcome to the live. All right. Can you hear me? All right. Today, we're talking about how to analyze a rental property. Welcome, everybody. Hope y'all had a great weekend. Hope you didn't lose any money betting on the Eagles last night. I heard that people were upset about some call that was made. I didn't watch the Super Bowl, but I know the Eagles lost. So hope you didn't lose any money there. Today, what I'm going to teach you is how to make money in real estate. One thing about real estate is that if you buy it right, you manage it right, and you buy the right type of deals, you'll never lose money. It's pretty hard to lose money in real estate so long as you follow a few key principles. What? We got any comments?
It just went on the right side. That's good.
Yeah. Welcome, Colby. Hope you're doing well, man. Where's everybody watching from? Are you watching from Philly, Kansas City, Austin, Texas, Washington, D.C., Denver, Colorado, Nashville, Tennessee, Atlanta, Georgia, Kennedy, Texas? All right, so today we're going to be talking about how to analyze a rental property. We'll look at a few different examples. We're going to look at a single family home. We'll look at a duplex, triplex, quadplex, 2 to 4 units, and we'll look at some commercial multifamily. It's all relatively similar. It all operates on the same key operating principles. And if you follow these rules, then, like I said, it's going to be very hard to lose money. Hey, Kat, can we somehow show this this whole thing right here? I just want to make sure I get you guys enough room here to see. All right, so one of the most important rules of investing in real estate is to always buy below market value. You never want to buy at market value. If you buy at market value, then you risk the value of that property decreasing and you being underwater. You having paid more for the property than it's worth. And one key way to secure your equity and to never have a property that's worth less than you paid for it is to never pay what it's worth. There's so many ways to buy deals below market value, even ones that are listed on the market, off-market deals. You never want to pay market value for these properties because if you do, then you will you have the potential that you could be underwater on them. If you bought a property in January of 2022 and you paid top market value for it, or maybe you even paid above what it was listed at, then right now you're probably underwater on it. The property is worth less than what you paid for it. I can pretty much guarantee if you bought at market value at that time. So first and foremost is never, ever pay market value. It's really important that you understand this, know how to negotiate this, and are willing to stick to this key principle. You never want to pay what it's worth. And it's so easy to not pay what it's worth. All you got to do is make a low offer. You can make low offers on properties that are listed for sale. When you're negotiating deals, you need to have the market value in your head, and you need to go below that and never pay market value to save yourself from being underwater on the deal. All right, Kat, can you look on your computer and see if this is clear? Because on mine, it looks like it's fuzzy. All right, number 2 is find cash flow. So we're going to run through how to find cash flow on a deal. It's a pretty simple concept. It's a pretty easy way to underwrite it. It's not too hard. Really what you're looking for is, and there's a few things that we're going to go over today. We're going to go over a DSCR. DSCR stands for debt service coverage ratio, because you want to get debt on the deal. You want a bank to finance it for you. We're going to go over rental income and other income. That's the top of your income statement. Then we're going to go over operating expenses, what these are, and how these will be deducted. Then we're going to cover NOI, which is your net operating income. You're going to be able to see what your debt payments are, what your net operating income is, the relationship between both of those. That'll give you your DSCR, your debt service coverage ratio. Then we're going to look at our cash flow, which is our net operating income minus our debt. And we are going to calculate what our cash on cash return is. So based on the money that you put into the deal, how much cash are you getting out of the deal on an annual basis? All right, so let's look at it. I'm going to leave this like this. I may come back to it. All right, so single family home. I will say this, single family homes are going to produce the least cash flow out of most of these opportunities that we look at. But let's look at a single family home. Single family home, let's say its actual value is $400,000. What was the number one key principle that you need to know when buying any type of real estate? TikTok, what is it? Instagram, what is it? Facebook, YouTube, what is it? What is the number one key principle that you need to know when you are analyzing never pay market value? That's right, Jordan Sanchez, welcome to the show. Good job, never pay market value. We're also on LinkedIn. All right, so if it's worth $400,000, are we paying $400,000? The answer is no. So what's a good percentage to buy below market value? If it's worth $400,000 and as is condition, what price do you want to pay? If you can get this in a hot market like Austin, Texas, around 75% of market value, then that's pretty good. So $300,000 would be 75% of the value of $400,000. So this is the value, but we want to pay $300,000. Offer. Now, why do we want to do that? Facebook, YouTube, LinkedIn, Instagram, TikTok, Cat. Why do we want to pay $300,000? Let's see if Kat's listening. She's got she's got the best education in the world. She's around this all day. So why do we do that? Well, yeah, so you can make money, but most importantly, so that you don't lose money, right? Because what we're doing here and the way that we invest like this and the way that you invest like this, you're never going to lose money. All right, so $300,000 is our offer. And someone give me a rental amount. What is this house going to rent out for? Jordan, Colby, TikTok. What's this house going to rent out for? Give me a number. Give me a number. Give me a number. What's it going to rent out for? Hot market like Austin. All right, Jordan says $2,800. Maybe that's high, but we'll roll with it. So the rental income. Billington, all right, welcome. We're going to roll at 28. It was the first number I got. So market rent is $2,800. All right, so we're going to take the rent and we're going to multiply it by 12. Why are we going to multiply it by 12? Anyone? Yes, that's right. Let the followers answer. What do we got? What are the answers? Why are we going to take the rental income on a monthly basis and multiply it by 12? Yeah, that's right. Because there's 12 months in a year. We're going to be looking at numbers on an annual basis here. All right, so what's 2,800 times 12? Kat, can you do the math in your head? The answer is 33,600. All right, so with a single family home, it's either 100% occupied or it's 0% occupied. You either got a tenant or you don't got a tenant. So we're going to assume that this is occupied 100% of the time. If you're looking at 2 to 4 units, maybe 1 unit is vacant. So if 1 unit is vacant in a fourplex, then it's 75% occupied. If 2 units are vacant in a 20-unit apartment complex, that means it's 90% occupied. So we also want to look at the occupancy and see how often this is rented out. But for the single family home, it's either 100% or 0%. So we're rolling with 100. Otherwise, you'd make $0. So here is your rental income, your annual rental income. All right. Now, if you're charging pet rent, if you're charging late fees, if you're charging application fees, if you're charging pest control fees, trash fees, utilities, these types of things would all be what's considered other income. For this single family home, we're going to put it as $0 just for simplicity. But if this was a 50-unit, 100-unit apartment complex, you would have a good amount of other income in there. But there is other income that you will receive from this property. So we take our annual rental income and we take our other income, we add them together. And so we've got total annual income. Gia, you want to analyze it? All right, so then we've got our total annual income of 33,600. Gia knows how to buy good rentals. She never pays market value. All right, so here's our total income, 33,600. Now we need to start subtracting expenses. Can we show the bottom of this thing, please? We can come down up here. We don't need all that up there. Like tilt the. All right, so now we want to start subtracting our expenses. So what are some of our operating expenses? TikTok, Instagram, Facebook, YouTube, LinkedIn. Tell me what some of these operating expenses are going to be. Anybody know? We're fixing this camera right now. We got property taxes. We've got, there you go, that's perfect. We got insurance. We've got management. We got maintenance, potentially utilities. Yep, repairs that are going to be done to the property. Can y'all see this okay? Jordan, can you comment and let me know if you can see this picture very well? Taxes, insurance, management, repairs. All right, so let's start doing some math. So first, what we want to do is look at our expenses, and let's assume that a $400,000 property in Austin, Texas, is going to have about $6,000 worth of property taxes. 6,000 taxes. Let's say the insurance on it, when I paid $300, is going to be $2,800 a year. Insurance. Our management is going to be 7% of our rental income. Who knows that number? What's our rental income? 33,600 times 0.07. How much in management fees are we going to pay throughout the year? Quick math, quick math. You want to analyze rental properties? You got to be good at math. And everything we're covering today applies to any type of real estate deal you're looking to analyze. So make sure you're taking notes. Make sure you write all this down. if you pay attention here, you take notes and you fully comprehend what we got going on. And when I open this up for Q&A, you ask the questions to things you don't understand. You'll leave here with an expert understanding of how to analyze a deal. Yeah, you could round down. 0.07 times 33,600 is 2352. $2,352 in management. You got to be good at math if you're going to analyze deals. All right. And then let's assume that we've got at least $100 a month in maintenance. So repairs and maintenance, let's just assume that it's $1,200 a year, maybe low, could be higher, could have none. So we're going to have $1,200 a year in maintenance. Now, if the property is in horrible condition, you could up that. If the property is brand new and it was just built, then you can safely assume that there's probably not going to be that much maintenance at all. But you need to know. When you're analyzing duplex, quadplex, commercial multifamily, you'll be able to look at the operator's T12, which is a trailing 12 months of financials, and you'll be able to see all these numbers right here. So what's our total expenses? We got 6,000 plus 2,800 plus 2,352 plus 1,200. What's our total operating expenses? Do the math. Quick math. Quick math. What are they? $12,352. Expense. OpEx. Operating expenses. All right. So our total income is $33,600. Our total operating expenses are $12,352. Now, what do we need to subtract next? Do we get to keep the difference between $33,600 and $12,352? The answer is no, unless you bought it cash. Which, if you did buy it cash, it wouldn't be an amazing deal necessarily, but let's look at it. Can y'all see all the way down here? All right, I'm gonna write an important number down here. So make sure you can, they can see it. I don't know about these guys though. I'm gonna write an important number down here, so make sure you know what it is and make sure you're paying attention. Are you saying that? Who said? Danger Will. That's right, Danger Will. All right, so we're going to take 33,600. We're going to subtract, that is our total income, right? Our rental income, 2,800 times 12. Annual rental income plus other income, which was 0 in this case, gives us our total income of 33,600 minus our total operating expenses, which is taxes, insurance, management, maintenance, and anything else that comes up along the way. But we're assuming it stays there. 12,352 gives us our NOI, net operating income. The difference between these two numbers is $21,248. NOI. What does NOI stand for? You taking notes? NOI stands for net operating income. Now, if we did buy this cash, $300,000 cash plus closing costs and other things, we would get $21,248 every year based on our $300,000 investment, assuming that all these numbers are correct. And that would be a 7% cash on cash return. We're going to take this NOI, we're going to divide it by the $300,000 purchase price plus other expenses. That gives us 0.0708. We're going to multiply it by 100 to get a percentage, and that gives us 7.08% cash on cash return. It's not bad. However, let's see if we can make it better. So we found our NOI. We've looked at all the numbers. Now, that's also your cap rate, by the way. 300,000, 21,000, NOI divided by purchase price is your cap rate. So now we're going to look at what our debt is. So our purchase price was 300,000. We did get a loan on it. Purchase price. Let's say we put 25% down. So 25% down, 75% financed. So we put $75,000 down, and we got $225,000 financed. All right, so let's say on this 225, we got a 7.5% interest-only loan times 0.075. That gives us $16,875 a year in debt payments. So now we got our, what was our NOI? NOI was $21,248. Our debt is 16,875. Did I do that right? 225. Yeah. All right. 7.5% interest only loan for the first 5 years. Here's our debt. Now let's look at our debt service coverage ratio. Remember, I said take notes. We're going to cover this. Write this down. Your DSCR. This is what the bank is going to utilize to look at this property and see if it's a good deal that they want to lend on. They're concerned that the property won't be able to service the debt. So they look at it with this ratio here, and they want to see that the income, the net operating income from the property, will be able to service the debt by at least 1.2, 1.25 times. So do y'all know the DSCR here? What is the DSCR for this NOI and this annual debt service? Cap, you know it? So what you're going to do is you're going to take your NOI and you're going to divide it by your debt. Annual NOI, annual debt service, and you're going to divide these two numbers right here, and it's going to give you DSCR of 1.259. So you're in the clear. Your DSCR is a 1.25. Your NOI services your debt by at least 1.25 times. So you're good. Now let's look at our cash flow. How do you get your cash flow? Kat, how do you get your cash flow? Don't be like Kat, guys. Take notes. When we cover these terms, make sure you write them down. Make sure you comprehend them. Yeah, 1.26, 1.259. All right, so your cash flow is going to be your difference between your NOI and your debt. So, 21,248 minus 16,875 gives you annual cash flow of how much?
Cash flow would be roughly 5,000.
Yeah, roughly. All right. So let's figure out our cash on cash return. This is our cash flow after our debt divided by our down payment, how much we put into the property, and our cash on cash return is how much?
Real rough.
Huh? Yeah, it's not great. 5.83%. So this is your cash on cash return. You put $75,000 in, you get 4,373 back. That is 5.83% on the cash that you put into the deal. All right, so it's a good deal. Do you buy it? In Austin, you buy it. You guys buy it? In your market, do you buy it? Colby says no. Colby, but it's worth 400. You're buying it for 3. You're getting some cash flow. You don't like it? You guys buying it? I'll tell you. Go ahead.
John De Leon says yes.
I'll tell you what. This is not bad for a single family house in Austin. This is not bad for a single family home in Austin. You're lucky in Austin to have this number be a positive number. Typically in Austin, you're negative $4,373 every year. You don't have a 1.26 DSCR in Austin. It's hard to go buy a property for 300 grand and rent it out for 2,800. That almost meets the 1% rule. It's like 0.95 rule. So it's very hard to find this in Austin. But this is how you would go through and analyze it. And if any of these numbers change, so will the returns, so will the NOI, so will the debt, so will your cash on cash return, your cash flow, everything. If we only rented this property out for $2,400, for $2,300, we would be negative about $2,000 here. If this property sits vacant for 2 months, you are negative for the year. Go ahead.
So Chris Reese's principal and interest payment must be negative cash flow ? And then John says this is better than the 1% rule. William says, I like the deal, especially walking into the equity that can be used for your next deal.
Yeah. All right. So this is cool. Y'all understand single family homes? This is how you analyze it. Same concept with a duplex or a quadplex. Now, all right, does everybody understand? Before we move on, if you don't understand, if you don't understand, write your question in the comment section before we move on to looking at a bigger deal. Colby, I know you're ready, man. You've been waiting to get to the bigger deals. Colby Capelli, the king of industrial. Any questions before we move on? Did y'all write all this down? Did you write down what NOI is? Did you write down how to calculate your debt? Did you write down how to calculate your cash flow? Did you write down how to get this DSCR right here? All right, moving on. Let's look at this. So that is how you analyze all property. All right, we got a question. Jordan, so cash on cash is what?
Kobe also said I didn't see the cash on cash part better. Now I see that.
Yeah, so Jordan wrote cash on cash is NOI divided by purchase price times 100. So it's actually the cap rate. But if you bought the property cash, then that is the return that you'd be getting. But since you didn't buy the property cash, we're utilizing the cash flow number, which is that 4,300 number. and you're dividing it by the amount of cash that you put into the deal. So 75,000. So 4,300 divided by 75,000 gives you your cash on cash return of 5.83 or whatever that was. Make sense? NOI divided by purchase price gives you your cap rate, which is the return you would get if you did buy the property cash. And the cap rate was like 7, I think it was 7% in that example. All right, so let's look at this. So let's look at a 24 unit apartment complex. And we've got 24 unit apartment complex under contract right now. What? Oh, we've got a 24 unit apartment complex under contract right now. And I want to show you all the power of buying 24 units versus 1 unit. No, you're good. You can stay zoomed in. I'd rather have it here than anywhere else. So I don't know these numbers. Matt's got all the financials, but let's run through the example of what it looks like. You want to run through a 24 unit? All right, go on. All right, so we got 24 units. Let's say each unit is rented out for $900 a door. Let's say the apartment complex stays 90% occupied. 90% occupied. Let's say that other income on the deal is, again, late fees, pet rent, stuff like that. Let's say it's $12 or $1,000 a month in other income, laundry facilities on site, things like that. I hope you took notes because we're going to fly through these numbers. All right, so $900 a door, 90% occupied, $1,000 in other income every single month gives us our total income of how much? This number right here is important. So make sure you factor it into your equation. Total income is how much? $900 times 24. Times 0.9 plus 1,000.
What we said is roughly 21 a month-ish or more.
Yeah, it's about 20,400 a month, or 200. We're going to look at it on an annual basis. $245,280. Let's just round it. 245,000. Simple math. All right, so this is your total annual income. And the reason we came up with this is we took $900 a door times 24 units times 0.9, which is 90% because it's 90% occupied, plus 1,000 times 12. Gives us total income of $245,000 a year. Now, let's say our operating expenses, taxes, insurance, maintenance, management, utilities, etc., is going to run us at, let's call it 40% of the income times 0.4. So our operating expenses, %, 98,000. This is in Kennedy, Texas. So property taxes might not be that much out in Kennedy, Texas. Property taxes in Austin, Texas are going to cost you an arm and a leg. So OPEX around 40%, $98,000 a year. Hey, by the way, as I'm going through this, this is not the actual numbers for the deal. But if you do want to partner on this deal, if you want to invest in a deal like this, send us a DM and let's talk, because we are going to be taking this one down. So 245 minus 98 gives us our net operating income of what? What's our NOI? Who's got our NOI? Anyone? Can you calculate it? $147,000 is our net operating income. All right. Now, if we bought this property, for $1.6 million, what's our cap rate? Cap rate. How do you get cap rate? Remember, write this down. NOI divided by purchase price. So, what did I say? 147 divided by 1.6 million gives us a cap rate of
We have 9% and 9.18%.
Yep, 9.18 to be exact. 9% cap. 9 cap. Makes sense. It is in Kennedy, Texas. Population 87,000. Y'all know the market. Population 87,000. It's got a correctional facility there. There's delivery drivers there. You got grocery store operators there. We're looking at our tenant base. Who's going to rent out these 24 units from us? They got a Dollar General. Do they have McDonald's? I'm not sure. But we need to know who our tenants are. If this was in Austin, Texas, you think we'd have a 9% cap rate? Probably not. It'd be much, much, much lower. Better location.
Someone's asking what's the 1,000 for?
Other income. Application fees, utilities being charged back, late fees, NSF fees, laundry units on site, other income outside of the rent.
It's a 24-unit occupied.
Yes, it is 100% occupied, but we're running it off 90%. All right, so that's our NOI. Now, let's say we're going to use debt on this deal. Go ahead, Kat. Tell us what's funny.
Dollar General, sign me up.
Dollar General, sign you up. I know it. All right, so 1.6 million. We'll likely have to put about 30% down on this deal. So what's our down payment? Something happened on Twitter. What's our down payment? Our down payment is $480,000, 30% of the purchase price. And that leaves our debt of 0.7, our principal balance of 1.12 million. 1.12 million. All right, let's run it again at 7.5%. So times 0.075, interest only debt, first 5 years, $84,000 a year in interest only debt payments. All right, so there's our NOI. Here's our debt, 84 grand. All right, what's our DSCR? Were you taking notes? What I'm telling you guys here, y'all can, if y'all would pay attention and practice this, you could underwrite deals in 5 minutes. We got a DSCR. What's our DSCR? How do you calculate the DSCR? Your NOI divided by your annual debt service. So we're going to take 147 divided by 84 grand. That's right, Jordan. It gives us a 1.12 DSCR, or sorry, 1.75. 1.75 DSCR. Does the bank like that? Yeah, the bank loves that. All right, cool. So we meet the DSCR requirements of the banks. Now, what's our cash flow? Anybody? What's our cash flow on the deal? Cash flow is NOI minus our debt, $63,000. All right. So now what's our cash on cash return? We put $480 down as a down payment. We get $63,000 a year in cash flow. What is our cash on cash return? Anybody?
I'm sure Jordan will get it.
TikTok? Colby, are you lost? You taking notes? What's our cash on cash return, Colby? Cash on cash return,
15%.
13. 13% cash on cash return. Colby, you like that one better? All right. Y'all like it? $63,000 a year, 13% cash on cash return, 70% financed. We got a loan balance of $1.12 million. It hits the 1.75 DSCR. Yeah, it's cool. 13% cash on cash return. Not bad. Now I want to show you something really cool. Remember these numbers. Hope you're writing all these down. This is where economies of scale come into what?
I'm using my brain and not a calculator while in the gym.
All right, good job, Colby. This is where the economies of scale and buying more units comes into play. The single family home, it's one unit. If it's vacant, you got zero income. When you're raising rents on the deal, you're raising rents on one unit. Here, when we raise rents on the deal, say year 2 of ownership, say we raise rents from $900 to $1,100, I want to show y'all the really cool value of this. Remember all those numbers. So now remember, we got a 24 unit, 90% occupied. All right. Now we are going to raise the rents by $200 per unit. So 24 units times 200 equals what? 24 times 200 times 0.9, which is 90%, equals what? 4320 times 12 to get your annualized number is $51,840. This is extra. This is what the $200 a month is going to do for us. We're going to raise rents on the 24 units by $200, 90% occupied, times 12. It's going to bring us in an extra $51,840 every single year. Now our cash on cash return is getting much greater. I want to show you all this though. So if we were to go and sell it in year 2, after we've raised the income by $51,840, and remember, our expenses aren't going to increase that much because we're raising rents. Yeah, management might get paid a little bit higher because they're getting paid based off of the income that's coming in. But all the other expenses to operate this facility are not going to increase just because we went to somebody and we said, hey, your rent is now $1,100 versus $900. You got a question? So I want to show you something really cool. We raise each unit by $200. And if we wanted to go and sell this property, in year 2, after we have brought in an extra $51,840 a year in net operating income, and even if we sold it at a 9 cap, I'm going to show you how much value we created here. So 51,840 divided by a 9 cap, so divided by 0.09, we just created, even if we sold it at a 9% cap rate, which we wouldn't do, we just created an extra $576,000 worth of value by raising rents $200, and that's it. All we did is raise rents $200. We bring in an extra 52 grand a year, and if we sold this property that same year after bringing in this extra income, we would have created an extra $576,000 worth of value. Do y'all follow how I came up with that? Yay or nay? Because remember, our NOI was 147. Forget this number. So our NOI was 147. And we added $52,000 worth of increased income because we raised the rents. So now what is our new NOI? 147 plus 51840. Our new NOI after we raised the rents in year 1, new NOI is 199 grand. $199,000. Now, if we sold this property in year 2 with our new NOI of 199, even if we sold it at a 9% cap rate divided by 0.09, we can now sell this property divided by a 9% cap rate, and we would never do this. We would sell it at a lower cap rate. But even if we did, our sales price would be $2,211,000. So we would have created value of about $575,000 just by raising rents by $200. And now this is what you're looking for. This is how you want to create value. Then you go refinance, get all your money back, and you own this property for free. And you keep raising rents as long as it permits. But this is the scale that you're looking for. This is the cash flow that you're looking for. You can definitely do it with single family homes, but in hot markets such as Austin or the suburbs of Austin or other hot markets around the world, you're going to lose money. You're going to lose cash flow every month by renting it out to a long-term tenant. You're just gambling and betting on appreciation. But right now more than ever, you want to be buying based on cash flow. All right, what questions do we have? Do y'all understand this? Did y'all write this down? Did you take notes?
This is off some info. Thanks for sharing.
Who said that?
Samantha Giovanna.
All right. Thanks for tuning in, Samantha. Samantha, you going to the event in April? Hey, come to our event in April, Samantha. We're putting on an all-day real estate workshop. You'll get to learn about a lot of stuff like this, plus a lot more. And you're going to be able to network with a bunch of great people. Find partners, find lenders, find people who got deals. And if you insist on staying in San Diego, you can even join virtually through Zoom.
Leroy is wanting to know what cap rate. What exactly is cap rate?
So cap rate is a relationship between NOI and sales price. So right here in this example, NOI, new NOI is 199, cap rate is 9%. And so that means that this new NOI of 199 is 9% of the sales price. So that's all cap rate is. It's a relationship between sales price and net operating income. And the way that you find it is you take NOI, so 199, you divide it by sales price, and then boom, your calculator spits out a cap rate. Cat, what else you got? It's getting hot in here.
Tell Samantha we'll message her.
Hey Samantha, marketing's gonna reach out and get you the link. They'll give you a discount too. For how many people we got watching? All right, for everybody watching here, if you send, I'm gonna hook you guys up. Don't tell anybody else we're doing this. But if you send us on whatever social media channel you're watching from, if you send us a DM and say discount, we'll get you discounted tickets to the April 29th real estate workshop. You do not want to miss out on this. What other questions we got? So Samantha, send us a DM. They're going to reach out to you, and we're going to hook you up with some discounted tickets.
Do you know the going cap rate in the community market?
It's probably like 7, 8, somewhere around there. 7, 8, 9, somewhere around there. Any other questions? Did y'all take notes? All right. Like I said, for anybody here who wants to go to that event, send us a DM on any of these platforms: Facebook, YouTube, LinkedIn. If you're on YouTube, just comment it. TikTok, Instagram. Send us a DM and say discount. We're going to get you a link for discounted tickets to the April 29th event. You don't want to miss out on this event. Even if you're sitting in here like Mr. Colby Capelli and you're an expert in industrial commercial real estate, it's possible that you are going to learn something new. But the most important aspect of coming to this event is not just the information and not what we're going to be teaching, but it's the opportunity that you're going to have to be able to network with people. It's going to be really hard to be successful in real estate just tuning into these lives. You got to go get out in the market. You got to meet people. You got to network. You got to build connections. You got to find people who have what you need. It may be deals. It may be capital. It may be both. So you got to get out. You got to network. You got to meet people. And here at this event, there's going to be over 300 plus real estate entrepreneurs. This is the biggest and the best real estate investment workshop in Austin, Texas in all of 2023. And you don't want to miss out. You're going to learn something that may jumpstart your career. You're going to meet somebody who may be able to give you what you need to take down a deal. We're going to be talking about exclusive deals in this workshop. And you got to join. You got to go out there. You got to do something. You got to meet people. And this is the perfect opportunity to do it. And because y'all are committed and y'all are tuning in at 12:53 on a weekday while you're eating lunch or Colby's at the gym, if you send us a DM and say discount, we're going to hook you up with exclusive discounted tickets to the event. No one else is going to get these, just y'all. So make sure you tune into that. Join if you can. If you can't show up in person, you can still join virtually. We got virtual tickets for sale too. And then at the end of this month, we're putting on a webinar. This webinar is free. You do have to register for it, but it is free. And we're going to cover how to find off-market deals. We're going to show you how to find motivated sellers, how to pull the list, skip trace the list, contact the list, how to find motivation. And that's going to be at the end of this month, February 25th at 11 a.m. on a Saturday. One last thing is we've got our Entrepreneur Academy. It's rocking and rolling. We are fully 100% committed to getting you guys the education that you want and need and desire. We've launched a wholesaling course at the start of this year in January. At the beginning of this month, last week, we launched our Flipping Houses course. We got more coming soon. Send us a DM with some topics or courses that you'd like to take and learn about. I think next I'll be releasing creative finance, seller finance, sub 2, all that. We also may launch some lead generation strategies. So your feedback's really important. We're putting out this education for you guys to get you everything that you need at your fingertips. So just let us know. Send us a DM. Thank you so much for joining today. I hope you took a lot of notes, and we'll see you again next Monday.